Well, that ain't going to last very long. And here we are 20 years later, right? It's still over $1.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this. Hey, Walter, let's talk a little bit about swing trading psychology. How is it different from other types of trading? What are your tips on becoming the best swing trader possible?
Well, I would say from the data that I've seen, from asking traders questions and putting them through a questionnaire, most traders are what you would term swing traders or end of the trend traders. So about 85% of traders like to find the end of the trend or like the end of a swing move, right? So they like to kind of like catch a reversal. It's almost unnatural for most traders. It's unnatural to try and buy at a high or sell at a low and assume that you're in a trend. So number one, if you're a swing trader, it's probably going to be quite easy from like a mental point of view to try and hook into these. Mm-hmm. The bad news is there's a real temptation, because a lot of times, let's say you're a swing trader and you get in on a pullback. So it's actually a trend. It's a strong trend, and it's going to keep going. It's going to keep trending. And so you find your reversal entry and you get in it. The problem is, that trend, that reversal is only going to go so far, and then it's going to continue on in the trend. So what that means is you have a very small window to take profit if the market's trending. And oftentimes, a lot of swing traders or reversal traders, end of trend traders, their radar really perks up when they see a strong trend, because they think, oh, it's gone too far. Like I'll tell you right now, I raised my hand as, back in 2001, I think it was, when the euro went over $1.
Hey there, I hope you're finding this episode useful. I just wanted to let you know that Walter and I give away something valuable every month that helps traders improve their skills. You can enter to win by simply leaving an iTunes review and leaving a comment on our YouTube videos. At the end of each month, we'll look at the comments and reviews from the month, and we'll pick a winner at random. Each comment and each review counts for one entry during the month that it's submitted. So if you're interested in that, be sure to enter after this podcast is over. All right, back to the episode.
And I remember saying to myself, well, that ain't going to last very long. And here we are 20 years later, right? It's still over $1. So, because when I first started trading, it was when the euro first came out. It was always below $1. It was like 87 cents, 89 cents, 92 cents. Like it was always down there, Mm-hmm. And so we always thought it was trash. The euro's trash, man. It was no good. And so I remember thinking when it got above $1, I go, well, totally time to sell. Well, that was like a 3-year bull trend, it's crazy. So it's natural is one. There's a temptation to take quick profits, which I think is bad. I think you're probably going to want to use some sort of element of a trailing exit, and also some sort of way of determining whether or not the market is trending or not, and make sure you just stay away from the trending market. So like if you see a box consolidation or a channel, there's lots of different, or trend lines or whatever, like if you have a line in the sand, you go, okay, it shouldn't go beyond this, like use that sort of thing. So like trend lines, support and resistance, anything that you can really sort of define the market as range bound or at least not trending, you're better off than looking at those wild charts where the market looks like it's gone too far and you just think it's going to come back because it's gone too far. I would stay away from those, and I would try and have a really high reward risk ratio, because like I said, it's really tempting to take profit when you catch these reversals and it doesn't really go that far. And then you start thinking, I better take profit or it's going to go against me, sort of thing, Yeah. So you're better off just moving to break even and then slapping a trailing exit on it or something like that. You know what I mean? And then saying, okay, well, I either hit break even or I really got one here. You know what I mean? Sort of thing. That's what I would do. But I mean, everyone's got to decide for themselves and test and figure it out if it's profitable.
Yeah, sure. I think definitely patience and lack of patience is definitely the hardest thing about swing trading. Just going through the testing and figuring out, okay, how am I going to exit? Does that exit work? I think is the toughest part. Otherwise, it's pretty easy from the standpoint that you can just take 1 or 2 trades a week. You don't have to look at the charts every hour or whatever. And but yeah, I would agree with you.
Yeah, for sure. Yeah, I mean, it's fun. I mean, it's fun, right? I mean, that's why a lot of traders get into it, because they think, well, this is obvious, like it's going to turn around here. And I think for non-traders or new traders, I think that's what they think trading is. Like you have to know where it's going to go. You know what I mean? Like trading is predicting the future, when really it doesn't. That's not
more
really
reactive than anything. Right?
Yeah, exactly. Yeah, exactly.
Yeah. Okay,
exactly.
cool. Thanks, Walter.
Thanks. See ya.
See ya. All information in this podcast is for educational and informational purposes only and is not trading or investment advice.